Hello, welcome to Financial Freedom with Jewel. Today we're going to talk about how you can use Velocity Banking to pay off $25,000 in debt in record time. We're talking less than a year. But you know me, I need you to give me one moment. I'm going to explain it all. I'll be right back.
You know I'm a stranger,
Welcome back. Today, as promised, we're going to talk about using Velocity Banking to run down record debt in no time. We're talking $25,000. But this person is a homeowner and they can use a HELOC. So we're going to go ahead and we're going to use the HELOC. Remember, you can use any type of debt tool, whether it be a savings account, whether it be a 401k, whether it be maybe possibly what? Let's say a HELOC. If you want to use a HELOC, you can do that too. We're going to use a HELOC today at a 7% interest rate. We're not going to get a second job. We're not going to rob Peter to pay Paul. What we're going to do is, remember my saying, if you don't tell your money where to go, you're going to wonder where it went. Today we're going to show and tell this money exactly where to go. In this case, it's going to pay down 2 credit cards. Now remember, with credit card debt, you're paying those credit cards for 5, 6, 7, 8, sometimes double-digit years. What they do is that they promise you, oh, you can make this little bitty small minimum payment. That's the key, minimum payment. After that, guess what? They're going to wrinkle you over the coals in interest. The goal is to extend the time out so it works for them, because as time goes and it lingers and it continues to go, guess what? Yep. That banker, that credit card company is making money off of you, but they're teasing you saying, oh, you only have to pay $100 a month. They're not telling you they're going to actually make you pay triple and double what you actually borrow from them, but they're going to squeeze it out over time. So at this point, we're going to flip the script and we're going to do it where we're going to pay off that debt. And then we're going to go ahead and say, okay, then done with these credit cards, using the wrong way. I'm going to use them the right way. With a credit card, if you treat it like a debit card, you're never going to get stuck in those rat races or those traps of paying the bare minimum payment, and the bank is going to win. Okay, take a look at this couple. Look at their income. Their income is $57.09. Expenses after everything is paid, $44.22. Look at their chart, you guys. Their mortgage, $20.27. Car note, $387. Now we're going to target that using the same strategy, another video. Insurance, $126. Credit card number 1 is $197. They owe $15,000 on that credit card. Okay, I'm guessing it's probably a 28% interest rate. Utilities are $407. Food is $420. Fund money, $250. Okay, we're going to stop there. Remember, with Velocity Banking, we encourage you to take out something. We say funding, we're talking about maybe movies, out to eat, things like that for a month. I'm going to ask you to go a little further. I'm going to say, go in there, get the cash, take it out of your bank, and put it in an envelope. You say, Jewel, why envelope? Because with an envelope, once that money is spent for the whole month, you cannot go back in there. That's going to be your boundary. I know sometimes the money's sitting in the account. You think, oh, I'll keep pulling. Before you know it, you've actually spent maybe $200 or $300 over your allotted amount for your fund money. So let's put the fund money in an envelope and let's use it. And when it's all gone, guys, it's all gone. So plan wisely. But with Velocity Banking, we want you to feel like you're not under so much pressure. We want you to allot fund money, things that you enjoy doing, like a diet. You feel like you don't see the measurable success. You're like you're just being forced to eat maybe beans or salads. You want a little bit of meat. What do you say in Velocity Banking? When it comes down to it, the fund money is like your meat. You get to enjoy the fruits of your labor as you're laboring to pay off your debt. Okay, here we go. Check out their savings. They're putting $300 a month. Great job. Once again, high yield savings, you guys, not a regular savings account. Throw it into a high yield savings. You can get about 4 to 5% and your percentage yield on your money. We're talking dollars, not cents. If you use a regular savings account at those big box banks, you're going to see yourself bringing in pennies saying, hey, thank you for your money. But while you've actually given them your money, they've made money and they're giving you pennies. No, high yield savings, that's the way to go. Okay, let's go look at the subscription, like streaming services. Okay, $108 a month. That's pretty good. Okay, now that we're done with all that, there's expenses. You guys, they have a cash flow of $1,287. It seems simple, doesn't it? I wish it was that easy. If that money is sitting in that account, I can guarantee you they're going to run through it and say, oh, I'm fine. They're going to live above their means because they're not targeting their money strategically. I've done it before. It happens all the time. So in this situation, we're going to target that $1,287. We're going to say, hey, you know what? You need to go ahead and use that efficiently. That's going to actually pay down your debts without a second job. Okay, but look at these. These are homeowners. They have a HELOC, a home equity line of credit. They've been able to go to the credit union. Remember, I love credit unions. They're nonprofits. They work for the members. So I use my local credit union. In this case, they have $45,000 they're just sitting on. You guys, I had a HELOC years ago and I didn't know what it meant. The banker said, hey, credit union, hey, Joe, I'm going to give you this HELOC. You guys can use it as you want to. And I'm thinking, okay, great. It's a line of credit. I didn't know then what I know now. Had I known, oh my gosh, you guys, I know. I don't want to digress and go into that. But anyway, if you have a HELOC and you have a home, you can go to credit union, you can get a HELOC. In their case, $45,000. Now it's at 7%. With velocity banking, it doesn't matter because we're going to throw all of that extra cash flow into our principal. So guess what? It doesn't matter what's your interest rate. Who cares? At this point, you're running down that payment so quick, the principal payment, they can get less on interest. That's the goal here. Okay? So here we go, you guys. Look, I'm telling them, call that credit card company, pay that $9,000 off using your HELOC. Pay that $15,000 off using your HELOC. You're like, what? You're moving debt. No, you're strategically moving debt to pay off the debt. Okay, you're leveraging your HELOC to pay off your debt. Okay, now we're at we're at $24,000 a day, paid off that debt. Boom, wiped out, it's gone. No more having it linger. That $15,000 they owe, paying $197, that is going to sit at least for 10 years, you guys. Remember, as that's sitting there, the bank is credit card company. They're counting you making those bare minimum payments because you're barely touching the principal. They're going to use time on their side. 10, 12 years, can you imagine how much they've actually got in interest? That's how they make money. Okay, so we paid off those cards. They're now at zero. But remember, when they're at zero, you don't go back in there and repeat and do all those things again. You come out of debt and you use your credit cards like a debit card. You want to make sure you're revolving your credit. That way, guess what? As you're paying your bills, your credit score continues to go up. So as I told you before, treat it like a debit card. If you go and you spend maybe $200, maybe say groceries, you go right back home the next day or maybe that same night, auto pay it and say, hey, on the first or second, send that $200 directly to my credit card because you're revolving the debt. Sad to say, the world works around a debt cycle, but if you're disciplined and you're throwing your money in there, you're using your credit cards as a debit card, you're going to keep your score always above board. That's a little secret. That was free. Okay, so we're all done with that. Now we have to say, okay, we owe $24,000 on that HELOC. That HELOC is at a 7%. Okay, here we go. Look, $24,000. But because we have that $1,287 as our cash flow, because we paid off the credit card, $200 goes away back in our pocket. $197 goes back in our pocket. You guys, that's an additional $397. So now we have a cash flow of $1,674. Yes. So we're going to do, when we get paid for that whole entire month, when we're going through our finances, that $24,000 has got to be paid back to the HELOC. So we're going to take that $24,000 we owe minus our positive cash flow of $1,674.31. Once we inject that, remember, because you're using that 7% interest rate, you have to pay the banker his interest, okay? He has to get interest. But because we're speeding it up, he won't get as much as what he would have gotten. Okay, first month, $137 is owed to him for taking out that $24,000. Now we're down to $22,463.19 to be exact. Okay, month number 2, same thing, $22,463. Let's inject that $1,674.31. We're moving, you guys. But remember, the bank has to get his portion, $128.70, because see, it's only the $128.70 because you're paying on the balance that's owed, which is $22. Now we're at $20,917.58. Month 3, here we go. Now remember, you've paid all your bills. You've been paying your bills every single month, okay? This is strictly you using your cash flow, okay? That's what we're going to do. So third month, you guys, $20,917.58 minus our positive cash flow, plus we owe the banker his portion. Remember, he has to get his portion. We're at $19,363.11. Month 4, $19,363.11 minus our positive cash flow, plus the interest payment due on the $19,000 is $110.93. We're at $17,799. Remember, all our bills are paid. We're going off our positive cash flow. Okay, month 5, $17,799.73 minus our positive cash flow, plus interest payment that's due. We're now at $16,227.40. You guys, can you see what's happening here? You are paying off debt swiftly. That's why they call it velocity banking, because you're rolling through paying off your debt. Remember, all your bills are all paid. Your HELOC is your debt tool. You've used that, and you still have $21,000 left in that HELOC. You can use it. Remember, with the HELOC, you can pick and you can pull from that, which means when you pay it back, you can continue to pull from it again. They're usually good for up to 20 years, you guys. You can pick and pull. You have to have it paid back within the 20-year time span. But with Velocity Banking, you're taking a big chunk out of it. You're putting it towards either your mortgage or your debt, and you're just paying it back every single month. You're revolving it. Okay, look at this, you guys. Month 6. 16,227.40 minus positive cash flow. We'll work off positive cash flow. Okay, here we go. Interest payment. Look at that, you guys. They owe $92.97 to the banker for, of course, using his money. But because they're only taking out of 16,000, they only owe $92.97. Within 6 months, they're down to $14,000 in debt for these credit cards. Okay, they paid those off, but the HELOC, they are down to $14,000. If you rinse and repeat this process, you guys, you're going to easily be able to see how they can pay this off, not in 8 or 9 years, not in 10 years, but you guys, you're going to have this paid off probably in what I would say. They'll have this paid off possibly a year, maybe a year and a month. You guys, you cannot beat that. With Velocity Banking, remember one thing I always tell people, you may think, well, that doesn't make any sense. No, it makes a whole lot of sense because you are now flipping the script. You're now using your cash flow, leveraging that to pay off your debts. Instead of you sitting in a huge, long payment term when it comes to like credit card payments or loans, things like that, you're taking a debt tool like a HELOC, a PLOC, personal line of credit, or maybe your, like I said, your 401k, maybe it's your savings you've put away for a rainy day. You guys, in that case, it's great because if you use a savings account, you're paying yourself back. So you're just going to borrow from yourself for a whole year to pay yourself back. Okay, that's the key. So as you can tell, they're done. So when they're done doing that and making those payments, you guys are sitting on $1,674 every single month. Now I'm going to say, hey, if you're into stocks, if you're into 401k investing, you can throw that into your 401k, especially if you have a good match from your employer. You are rolling in the dough. But oftentimes what we do, we sit around and we kind of think, oh, I'll make my bare minimum payments. My bills are all paid. But you're not looking at how you can actually speed up that process using a debt tool, using something that you can use to leverage debt to get out of debt. It makes all the sense in the world. I'd rather go ahead and do this, speeding up the process, than me sitting in a loan for 8, 9, 10 years on a credit card debt and knowing that as I'm sitting there for 10 years, they're raking me over the coals and interest, and I'm basically going to hit my principal probably within maybe the year 6 out of year 10. But in the meantime, they made all that money. Okay, so once again, I'm just trying to show you what's possible using your positive cash flow. But remember, when you do Velocity Banking, you have to be a disciplined person if you're going to use a HELOC. You're not using a HELOC to go on this fancy vacation. You're using it to get yourself out of debt and to make sure that you're in a really good financial situation. The goal is, you guys, debt freedom. And then guess what? You can enjoy all those wonderful, beautiful vacations because even if you go and use your credit card, the minute you get back home, you are going to send the money directly back to your credit card. You're not going to let it accumulate. You're not going to say, oh, I got 30 days to pay it. You're going to pay it right then. Remember, this world, it revolves around debt. But the good thing is that when you leverage your debt and you say, hey, listen, I'm going to use my credit cards like a debit card, you're going to benefit, not the banker. And also you're going to benefit because your credit is going to continuously rise and you're just going to be a really financially, fiscally sound person. But I digress. To the next video, I'm Jewel. I'm your financial freedom friend. I'm here until you absolutely win. You guys, this is a winning strategy. Okay? Next video. See you later. Bye-bye.